Hey everyone, welcome to this deep dive into fair value gaps and inverted fair value gaps. These are powerful concepts from smart money concepts and inner circle trader methodologies used by advanced traders to identify market inefficiencies and potential reversal or continuation points. We'll keep it straight to the point but go deep into definitions, identification, mechanics, and trading strategies. Let's get started. What is a fair value gap? A fair value gap is essentially a price imbalance or inefficiency on the chart, created when the market moves rapidly in one direction, leaving a gap where little to no trading occurred. This often happens due to strong institutional buying or selling, like during news events or order imbalances. In technical terms, an FVG is typically identified in a three-candle formation. For a bullish FVG, look at three consecutive candles where the high of the first candle is below the low of the third candle, creating a gap in between. The middle candle is usually a strong impulsive move. The gap boundaries are the high of the first candle upper limit and the low of the third lower limit. For bearish FVGs, it's the opposite, low of the first above high of the third. Why does it form? Markets seek efficiency. When price skips over a range quickly, it leaves unfilled orders, buy-sell liquidity in that area. Smart money institutions often engineer these moves to accumulate or distribute positions at better prices. FVGs act like magnets. Price tends to return to fill them, meaning trade back into the gap to balance the inefficiency. How to identify and trade FVGs. Identification tips. Use candlestick charts on any time frame, e.g., 5-minute for day trading, daily for swings. Scan for impulsive candles with no overlap between the first and third candles' extremes. Confirm with volume. High volume on the impulsive candle indicates strong momentum. Context matters. FVGs in trending markets are more reliable than in rangy ones. Trading strategies. Gap fill entries. Enter trades expecting price to revisit the FVG. For a bullish FVG below current price, buy when price approaches the upper boundary, targeting lower boundary or beyond. Confluence with other tools. Combine with support resistance, order blocks, or Fibonacci levels. For example, if an FVG aligns with a 50% 5 retracement, it's a high probability setup. Risk management. Place stops outside the FVG, e.g. below the low for longs. Aim for 1-2 risk reward or better. Advanced, in ICT, FVGs can signal displacement phases in market structure, where price breaks structure and leaves imbalances. Potential pitfalls. Not all FVGs get filled immediately. Some may take time or invalidate if market sentiment shifts. HAT is an inverted fair value gap, IFVG. Now, inverted fair value gaps. An IFVG happens when a standard FVG is invalidated, price trades fully through the gap, filling it, but creates a new imbalance. If price then closes beyond the opposite boundary, the original FVG inverts. Think of it as the market rating the gap for liquidity before marking the end of a retracement, resumption of a trend, or a fame reversal. It turns failed inefficiencies into new opportunities, often showing smart money trapping retail traders. Why important? IFVGs highlight failed inefficiencies that become new opportunities. They often appear after liquidity sweeps or fakeouts, showing smart money's manipulation to trap retail traders. How to identify and trade IFVGs. Identification. Start with an existing FVG. Watch for price to sweep through it, e.g. wick, or close beyond the far boundary. The IFVG forms in the area where the invalidation happened, often as a new three-candle structure in the opposite direction. Use higher timeframes for confirmation to avoid noise. Trading strategies. Reversal trades. After invalidation, enter in the direction of the inversion. For a bullish IFVG inverted bearish FVG, buy above the new gap, targeting previous highs. Liquidity raid setups. Combine with liquidity pools, e.g. equal highs-lows. IFVGs often follow sweeps, so trade the reversal post-sweep. Multi-timeframe analysis. Spot IFVGs on lower TFs within higher TFVGs for layered entries. Risk. Stops beyond the IFVG's extremes. Targets at next structure or 1, 3 RR. Deep insight. IFVGs are more aggressive signals than standard IFVGs because they indicate a failed trap, often leading to stronger moves. However, false invalidations can occur in choppy markets. Real-world example, take Bitcoin in mid-2025, a bearish FVG formed during a sell-off. Price retraced, filled the gap, but then inverted it by closing lower, creating an IFVG. This signaled further downside, and traders shorting post-inversion captured a 10% drop. Always backtest these in your market stocks, Forex, crypto for best results. That's FVGs and IFVGs unpacked. Core tools for understanding market manipulation and inefficiencies. Practice on demo accounts, combined with other ICT elements like order blocks. And remember, context is king. Now let's find some real examples of FVG and IFVG. On daily time frame, we got an FDH. And to trade this, let's go to lower time frame. We going to the 1 hour time frame. And if you look closely, there's an FVG right after the FVG. For now, let's talk about our bearish FVG setup. Here you can see we have gotten a strong rejection candle here. So what we do, we take entry at the next candle and keep the stop loss at above FVG high and target at low swing points based on swings. Now let's look at the FVG we just spotted. You can see that this is in failed FVG, which gets converted into FVG to trade. And analyze this, let's go to lower time frame. And here there's no strong confirmation here, but there's a normal confirmation here. Here the buyers tried but failed, which is a confirmation. These types of N raises are risky, but worth trading them if you have a good RR ratio like 1:3 risk ratio. And we don't see any swing points here. So we just triple our stop loss points and make it as target, which gets us to 1:3 risk-reward ratio. And now let's look at the final example of FVG. Here in New Zealand and US dollar here, we spotted a bullish FVG. But look how this FVG is actually risky. And remember, I told you many times the stop loss should be below the FVG or above, because here we got two N rays and both times we got stopped by institutions. If we kept our stop loss at the right above and below the FVG. And here our first entry got failed, but the second entry got succeeded here. Now go back test in Forex pairs, indexes, and stock, and practice and replay. Get your own confirmations set up with FVGs and IMVGs. Backtest at least a week of data, or month if in higher time frame. Now let me tell you some FVG and FVG trading tips and tricks. FVGs can be traded for gap fills, trend continuations, or reversals. Here are compiled tips from various strategies. Identify using the 3-candle method. Look for a strong momentum candle 2 to 5 times larger than surrounding ones, between 2 candles with no overlap between the first's high-low and the third's low-high. For bullish FVGs, the third candle's low is above the first's high, reverse for bearish. Prioritize fresh, untested gaps formed during high-volume sessions like London-New York overlap for higher reliability. Use multi-time frame analysis. Spot FVGs on higher time frames, e.g. daily, for market direction, then switch to lower ones, e.g. 15 to 30 minutes for entries and exits. Align gaps across frames for stronger signals. Avoid 1-minute charts as they're noisy. Trade as support resistance zones. Treat FVGs as areas price respects rather than always filling. Data shows 60% remain unmitigated in a session. Enter on retests with confirmation like rejection candles or volume spikes. For bullish FVGs, buy on support holds. Combine with other concepts. Pair FVGs with order blocks, breaks of structure BOS, liquidity grabs, or moving averages for confluence. For example, enter trend continuations after a pullback to an FVG in the trend direction. Entry strategies. Use classic retests. Wait for rejection patterns like pin bars or aggressive limits at the 50% FVG level. For gap fills, enter when price approaches. Targeting the opposite side. Risk management. Set stop losses beyond the FVG, e.g. below for longs, risk 1-2% per trade, and aim for 1-2 plus risk reward. Calculate position sizes based on gap volatility, smaller for larger gaps. Avoid common pitfalls. Don't trade every FVG. Filter for trend-aligned ones. Be patient. Gaps may not fill immediately. Backtest setups and avoid over-leveraging. Tips and tricks for trading IFVGs. IFVGs are advanced, signaling reversals or continuations after FVG invalidation. Focus on high-probability setups. Identify types in contexts. Bullish IFVGs form when a bearish FVG is broken upward, becomes demand. Bearish when bullish FVG broken downward becomes supply. Look for them after liquidity sweeps or in discount premium zones. Trade with confluence. Don't use standalone. Combine with trend analysis. BOSS, change of character, CHOC, order blocks or SMT divergences. Align with higher time frame bias for better odds. Step-by-step entry. Wait for FVG break with momentum, then retest from the opposite side. Enter on confirmations like lower time frame structure shifts or candle rejections. Use limits at IFVG borders. Aggressive versus conservative approaches. Aggressive, market order post-formation. Conservative, limit on retracement for better risk-reward. Add confirmations to avoid wide stops. Risk management. Place stops beyond the IFVG or recent swings, 0.25 to 0.5% risk. Scale out profits at multiple TPs, e.g., 40% at 1-1, rest higher. Diversify across
markets. Avoid mistakes. Skip choppy markets or low volume times. Wait for price reactions, don't predict. Backtest to spot bullish versus bearish preferences. Remember, these are tools, not guarantees. Practice on demos and adapt to your style.
If this helped, like and subscribe for more trading deep dives. Drop questions below.